Well, the global market focus turned towards China as House Speaker of the US, Nancy Pelosi, went to Taiwan to meet with Taiwanese officials, which, of course, meeting of which is ongoing at the moment, and that has kept markets largely docile in trade on Tuesday. In fact, US markets actually fell off a little bit, second day in a row of declines for US indices, and couple of reasons. One is, of course, House Speaker Nancy Pelosi going and meeting with Taiwan, and tensions with China on a little bit of a rise on the back of that. But the other and rather primary reason for the slight dip in US indices was the fact that there were several Fed presidents who've come out and spoken that there is still a 75 basis point hike possible in September, and that means that the Fed has not come off from its high of 75 bips in terms of its hikes. Now, mind you, currently the Fed's fund rate is at around that 2.5%. So the expectation was that a 50 basis point hike in September, followed by a couple of 25 basis point hikes to end the year, would take the rates somewhere at 3.4%, which was the target. But currently, with 75 bips on the table, that could go up slightly more in terms of what the Fed's fund rate would be at the end of this year, which is currently being discounted at 3.4, 3.5%. So that will mean valuations will come off slightly. Of course, on the back of that, bond yields went up. So we saw the US 10 as well as 30 across the board. We saw bond yields rise. In fact, the 10-year bond yield rose 18 basis points in a matter of a day or so. So we saw that sharp rise in US bond yields. Now currently the 10-year bond yield around that 2.75%. It was at 2.5%, 5.253% the same time yesterday. So that sharp spike, if I can term it, has been seen, and largely we are going to see an increase even next year. That's what the commentary comes in as. That's the opinion at the moment. There is an expectation of moving towards that 4% mark. Now mind you, since 2008 the US Fed fund rate has not hit 4%. So we've been 15 years since we last saw that kind of a rate, and that if it happens in 2023. That's where it stands, and that's why we saw a bit of a decline in US indices. In fact, the Dow was down around 1.23%, the S&P 500 down around 2/3%, and the Nasdaq down a more tepid, more mild 16 basis points in trade yesterday, but a second consecutive day of decline. So that's a bit telling. But in terms of the US futures shifting focus, those are in the green. So largely positive cues coming through for the US futures. Of course, need to wait and watch how US markets open in trade today. In terms of Europe, of course, the negativity across the globe is also pouring into Europe. So Europe largely closing lower. We did see across the board the DAX, the FTSE, as well as the Stock 600 all closing slightly lower, but mildly lower. Moving quickly on to how Asia has opened, it's been a mixed start for Asia, at least early in trade today. We are seeing the Nikkei make gains over 0.5% higher for the Nikkei, and we are also seeing the Kospi make gains nearly 0.5% higher for the Kospi as well. The ASX 200 is 0.5% lower. So on the other side of that, we're looking at the SGX Nifty around 1/3% higher. So we are seeing gains on the SGX Nifty as well. And in China, we're looking at both indices looking in the green. We're seeing the Hang Seng up around 0.25%. We're seeing the Shanghai up around 1/3%. So positive on those fronts as well. Moving quickly and shifting focus to commodities. Of course, oil was a matter of good discussion after those oil prices came off. We did see oil come off from that $98 a barrel to around the $93 a barrel, moved up slightly with the OPEC plus meeting in focus now. And of course, there is largely the view that OPEC will not budge on Biden's pressure of increasing production. But that's the general view at the moment. Have to wait and watch how that plays out. But at the moment, due to that, oil prices have spiked just a wee bit higher, around $94.25 a barrel as we speak, and Brent inching just above that $100 a barrel mark at the moment. So that's where oil is at. Moving quickly on to gold, the risk of trade of course at play, but the dollar index continues to gain slightly, which is why gold has come under pressure. Gold, which had moved to that 1790 plus dollars an ounce, has moved off towards the 1780 dollars an ounce, so 1% lower for gold at the moment versus yesterday. Moving to the dollar index itself, sharp move that we've seen in the dollar index. The dollar index has gone above the 106 mark as we speak. In fact, it's slightly above, holding on to that 106 mark at the moment as well. So it went up to 106.2s, come off slightly. It was at 105 yesterday, so a good spike seen in the dollar index, and currencies due to that will come under pressure, including the rupee. Moving lastly on to bond yields, we did speak about bond yields. Moving towards that 2.75% is where the US 10-year bond yield is. Currently around that 2.72% mark, but a good gain for the 10-year treasury as well as across the board for treasuries on the back of that commentary. Lastly, moving to crypto, well, Bitcoin continues to be under pressure below that $23,000 mark for Bitcoin. Of course, that pressure largely due to the fact that bond yields have moved higher, so Bitcoin will come under pressure just like gold. So largely that's what's at play. Currently we're looking at a mild positive, especially for Indian indices. Marginal positive around a third of a percent is where the SGX Nifty currently is gaining at. So that's where we see global markets, global cues largely mixed for Indian indices.